Let's get across the market open. Henry Jennings joining us in Marcus today. Henry, happy Friday to you. So I'm interested what we're seeing on the local market at the moment, expecting to continue to fall this morning, despite what we saw, particularly on Wall Street with new record highs.
Yeah, good morning, Andrew. Yeah, it's strange, isn't it? The SPY, it's always a bit of a conundrum, that one. 37 points down for the SPY. Wall Street at record highs, although the Dow falling because of United Healthcare. So took some of the steam out of the sails there. But the US really is kind of milling around at the moment. It's making very small incremental gains. It is very much focused on individual stocks at the moment due to the reporting season. So Nasdaq was always going to be a little better on the back of the Alphabet numbers. Tesla fell quite hard on the back of their numbers, but I guess the main event last night was the building site visit from Donald Trump to Jerome Powell and talking about renovation costs. And as we all know, renovation costs always go up and they're always longer than you expect. And the Federal Reserve is no different in that respect. But yeah, pretty unedifying to see that interaction between those two, although Trump did back away from calling for Federal Reserve Chief Jerome Powell to be sacked while he was talking to him, which I guess that's kind of good. But yeah, our market, I guess, limping into the weekend is the answer, although I'm a little surprised that the SPY is showing a loss, but we'll wait and see. Yesterday there was a couple of stocks and the banks, as always, the pivot point in terms of whether the index is up or down at the moment.
Yeah, in fact, Macquarie proving to be a big drag on the broader market yesterday as well. Look, we do have some updates out this morning, particularly in the resource sector with Newmont.
Yeah, Newmont, well, as you remember, that was my stock of the year back for the Advent calendar for Ausbiz. So that one's been going pretty well, and it still looks as if it's going to continue to do well. I think it was up around 3% after hours on the back of these numbers. What was interesting was Newmont has now seemingly got costs under control. So the all-in sustaining costs down 4% to 1593 in the second quarter. So that is a good news story, as it had been plagued by higher costs, some inflationary pressures creeping into the numbers there. So that is a positive there, of course. The gold price easing off slightly last night in US trade, so that is a little bit of a negative, but Newmont certainly doing well, and I think they authorized another 3 billion in terms of buying back stock if and when they want to. So that's all good. Newmont will continue to be the one, I guess, to follow in terms of our market for gold exposure.
Yeah, how are you playing that at the moment, Henry? Or are you preferring a bit of diversification there, perhaps with those goldies that also have copper exposure?
Well, yeah, I mean, it's very volatile, Andrew, and I think it's almost a day-to-day proposition. Gold is always such a sentiment commodity, isn't it? I think, we saw the Northern Star collapse on the back of their production issues and higher costs. We've seen Evolution come down quite hard as well. Of course, they do have copper exposure. And as I wrote yesterday in the newsletter, you're in a copper boom, and we are, when you see the likes of Bougainville, which had a very, very good day yesterday on some big volume. And then after trading hours came out with a statement saying that they're looking for international partners for their Bougainville copper project, which has been in mothballs for, well, as long as I can remember, as long as I've been in Australia anyway. So that would take some opening, to say the least. But clearly we are in a bit of a copper boom at the moment. Copper price is looking pretty strong. Evolution is one way to play it, but it has had some issues. So I'm still waiting. I think patience in the gold sector is the name of the game, and really to sell into irrational exuberance and strength when things get a little bit out of control, which they do from time to time. But at the moment, I think the gold sector, I think there's probably, we're kind of rotating around resources. Yesterday, we saw lithium do very well after a pretty anemic start. And we've seen splutterings in uranium, splutterings in coal, iron ore. So we are rotating around these commodities. Maybe gold is one to just be patient with at the moment. Although, you look at the bullion price, it's still pretty elevated, to say the least, and was close to 3,500 earlier this week. So gold's still attractive. I still long-term bull, but I think you just have to be patient and let these other sectors hog the limelight for the time being.
Henry, you did mention coal there. Whitehaven out with its update this morning as well. In fact, it's been doing quite well in recent times.
It has. It can be quite volatile, but it certainly there are some moves in China in terms of Chinese coal producers. So that is helping, I guess, the Whitehaven story. Looking at the numbers just this morning, they look a little better than anticipated in places. So that is a positive. I'm just looking at them now. ROM reporting managed ROM coal production 39.1 million tons. Guidance was 35 to 39.5. So that's better, and unit costs were also a little bit on the downside as well. So that was came in at 139 versus 140 to 155. So it all looks relatively positive for Whitehaven, but of course it's always at the hostage of underlying coal prices.
All right, and I guess more broadly, trade talks remain in focus. Look, investors fairly buoyed about what they're hearing at the moment. Of course, we have had just a deal struck between the UK and India,
Yeah.
and the Europeans remaining hopeful they're going to get something across the line as well.
Yeah, I guess what is concerning to some extent is that the baseline, which was kind of well, assumed to be 10%, has now been moved up to sort of 15%, that being the baseline. Japan obviously got a better deal than some were expecting. But, the reality is these tariffs have got to be paid by someone. If you're importing a Toyota into the US or whatever, they're going to be 15% more expensive. Now, either Toyota is going to swallow that and that will affect their margins, the importer is going to pay that, or the consumer is going to pay that. Maybe the three of them will split the 15% between them and pay, 5% each. But whatever you think, these tariffs are not particularly great news. And the market is certainly ignoring them because we've started with tariffs going to be 100%. So when they come in at 15%, everyone's happy. It's still 15%. That's still a lot. That's still that's more than we put on with GST back in the early 2000s. So that had an effect on inflation. There's no doubt, and I did a piece on that recently, how the GST at 10% bumped up inflation. But the RBA kept on hold and waited till it sort of filtered through the economy. The Fed's doing the same thing and probably doing it rightly so and copying a lot of flack for it. But 15% is still 15%. So, it's still going to have an effect. We just haven't seen it yet. And it will take time for that effect to come into to fruition.